So as we close the books in the first half and look ahead to Q3, how should investors be positioned? And Karen, we are just, welcome back, first of all.
Thank you.
We are discussing how extraordinary this quarter has been.
Mind-boggling. I mean, so many just, for obviously the April low was in itself extraordinary, so to bounce from that, but just, the NVIDIA, for example, from 108 to 157 in the quarter. Yes, they had good earnings, but that can't be all of what happened there. So, I mean, the sentiment change, Meta up almost, 30%, JP Morgan up almost 20%. It's really kind of insane. And if you think about what's happened, a lot of the stuff you could imagine this was going to happen, where there was going to be a big bill, right? They were going to look to extend the tax plan. And you thought, okay, they'll come to some deal on tariffs. But yet the intra-quarter swings are just absolutely extraordinary. So I don't know what to do about next quarter. I hope we don't have anything like this. The idea that we ended this quarter with a VIX of 16 and change is really kind of amazing.
Yeah. I mean, does this tell you that the market's rally is it's able to withstand all of this? And here we still are, Tim. So does that give you more confidence in where we are?
Well, sentiment is very different than fundamentals. Lori's got some views on this, I know. And it's also very different than where the economy is. And I think we all have reason to be a little bit cautious on the second half. I will say this about the first half, is that this was one of the worst first halves for the dollar on record. It's certainly one of the worst first halves for the dollar since the 70s. And you talk about just that 2Q, it was almost a 7% move lower in the Dixie, or the dollar index. So some of that is very good for markets, frankly. Some of that is good for risk in the short to medium term. In the long term, it's raised a lot of structural questions about trade, the economy, deficits, the confidence in the United States of America. But for the stock market, it's actually been positive. So I think about the second quarter, and I think about the reemergence of that obvious trade, which is that the biggest tech companies in the world have reasserted themselves. And if you're a market player, this is exactly what you wanted to see. I mean, we closed the 2Q, and I've talked about how close we've been, and we haven't gotten there just yet. But the Nasdaq's really on the precipice of making a new relative high against the S&P. That's the most important thing for me. I think the semiconductor trade, it was dented, but not knocked off its track. And I think that's another big part of this.
Yeah, I'd just say the real risk right now is if you're looking at really the S&P, the Nasdaq, they've just made these brief new highs here. When I say brief, they've just gotten above the prior highs for just a very little bit. The fact that we closed the end of the quarter, the end of the first half, right there at all-time highs is pretty amazing. To Karen's point, you have a VIX, below 17. You have crude oil, which basically is down on the quarter, which I don't think any of us would have expected given some of the geopolitical headlines that we've had, that for some, for all intents and purposes, maybe are not resolved there. The dollar, to Tim's point, great for multinationals, right? And it really does help that big tech trade. The one thing I would just say is, if you think that tech's going to continue to kind of drag this market higher, well, you better be careful just a little bit, because it might not take much for the dollar to move a little bit, or the crude to move back higher. I just look at energy, materials, home builders, retail, and I'm missing one. Oh, pharma. These groups can't get out of their own way. So it's not that broad of a rally. And you could say, well, industrials are doing really well, and there's some other areas. But if you just think about what the Fed just said to us a couple weeks ago, they took down their growth target for the U.S. for the back half of the year, right? Interest rates, you think about where yields are. I can't remember another time where market participants and even the Fed were so confused about why the next move might be lower. Just think about that, okay? Because there's a scenario where they might be able to do it. Inflation gets towards their target. Growth kind of solidifies here. We don't have this stagflationary sort of environment. But then the flip side of it is, if you want to focus more on where they're concerned, labor and growth, that sort of thing, well, then is that old playbook where you have to lower interest rates, or there's something geopolitical? So that's the one thing. I look at low levels of like the VIX, and then I think about the dollar trade, why it's being sold, and then the lack of clarity why they might lower Fed funds and what that does to the 10-year. So to me, I think that makes it a little bit more challenging in the back half of the year.